Today we are talking about homeowners associations. So how are they taxed, and is there anything that you should be looking at in a bit more detail? Welcome to Tax Break, your podcast for South African tax professionals and practitioners. As always, I want to ask you to rate the podcast on your favorite podcast platform if you're enjoying the podcast, and to also subscribe for it. Then your phone would notify you if there's a new episode that you can listen to. I also want to ask you to share the podcast or the link to the podcast or an episode with any colleagues who you think might also be interested. I found that that's really the best way of growing the listener base of the podcast. For those of you who listen on a regular basis, you would remember that I previously introduced the Tax Break app. So the whole idea with the app is that you've got a platform where if you want to request an episode on a specific topic or a fact pattern, you can post it on the app, and then other listeners can see your idea and give it a like or a thumbs up if they think it's a good idea and they want to listen to an episode on that. And then I can get an idea as to where there's a need for an episode from a content perspective. So if you want to go to the app, it's tax.pvdz.co.za/app, so app. You are still welcome to, if you've got suggestions, questions, or if you need tax advice, to of course send me an email as well. My email address is in the show notes. Right, so back to our topic of today. We're talking about the taxation of bodies corporate, share block companies, and voluntary homeowners associations. The reason why we are talking about this is that SARS in December last year published issue 5 of interpretation note number 64. And if you compare issue 5 to issue 4, then you'll see that the new version is much longer than issue 4. So there's a few new things to consider in there. Right, before we go to the technical detail of how this provision works and some of the administrative requirements, let's first talk about why is an exemption necessary. So if you look at bodies corporate, your share block companies, and then these voluntary homeowners associations, these things they all fall within the definition of a company, which is a person. So if this person receives anything, including levies, that would form part of its gross income. And without Section 10(1)(e), this gross income is taxable at 27%. Now, thinking about why this entity exists, it's really a collection mechanism or a pooling mechanism for members to pool funds that they're going to use for some purpose relating to their shared property. So there's going to be inflows, and then collectively they are going to use this money for purposes of their property. So if you think about this vehicle or this entity from that perspective, there's really no tax event, because in the absence of this vehicle, the owners or the members would have just spent the money on their own. So conceptually, there's an argument to say, but because it's just a pooling mechanism, this entity shouldn't really be picking up any tax liability, especially on levies. Now, I think if we go past the point to say, but right, it is an entity, it is receiving an amount, there could also be then an argument to say, but would it not by itself be tax neutral? So in other words, the inflows and the outflows should be equal, so there's no real tax problem. Now, there are some deeper structural issues with this argument. One of them is that if you're looking at something that's being funded of a capital nature, like fencing, paving, putting a guardhouse in place, that's typically the types of expenses that these entities would incur. There is no deduction for that. So you might end up having an inflow without the deduction for tax purposes. Assuming that you do get the deduction, so it's more operating types of costs, you also have the potential problem that it might be debatable whether this entity is trading or not. So does it actually qualify for a Section 11A deduction? If we assume it does, and the entity only has operating type of expenses, we're sitting with a potential third issue, and that's that there could be a timing mismatch between when the levies are collected and when they are actually spent. And if you've got more collections in a year than you've got spent, then the entity may still end up with a tax liability. So by exempting the levy income, we get the arguably the correct policy outcome on these entities. Right, so I've mentioned that there are three types of entities. We've got bodies corporate, share block companies, and associations of persons. The associations of persons we find in paragraph CC of section 10(1)(e). And I think the important thing about the three types of entities is if we look at the bodies corporate and the share block companies, they are automatically exempt under section 10(1)(e). So in other words, the levy income that they receive, and we'll talk about the levies just now. The associations of persons must, however, apply. So I guess that brings the question, what makes a homeowners association different from the other two? And I think the answer lies in the fact that bodies corporate and share block companies are governed by other legislation. So they are actually regulated types of entities, whereas your voluntary homeowners association is not. It's really an agreement between residents of certain areas with a common property. So I think that's the reason why they need to apply, because they, depending on how you've set up your contractual arrangement, you could or may not meet the requirements for the exemption. Right, so how does the exemption work? Levy income is fully exempt, and you'll see that in the interpretation note, SARS goes into a lot of detail as to what is levies and what not. If you've got non-levy income, there's a basic 50,000 Rand per year exemption. Anything above that would be taxable. And because a portion of your non-levy income is exempt, you may need to then do apportionment of your related deductions. That's now the expenses relating to the non-levy income. Right, then moving on to, and from here on, mostly focusing on homeowners associations, a few things that at least caught my eye when I compared the different versions of Interpretation Note 64. So, as I've already mentioned, the bodies corporate and the share block companies have an automatic exemption, so no need to apply for that. But the homeowners associations must apply to the tax exemption unit for the exemption. The reason, or if we look at the legislation, it says that the commissioner needs to be satisfied about the purpose of the association being to manage the collective interests in immovable properties of the members. The entity must not be allowed to make distributions and must not take part in tax avoidance. Now, I think if you read paragraph 7 of the interpretation note, you sort of get the perception that this process of applying to SARS might just be good practice, but if you then look at paragraph 13, I think it is clear that SARS's position is that you need to apply for the exemption. SARS will then, if it's approved, to give you a confirmation letter with a unique reference number. The other point that is specifically addressed in issue 5 is that the commissioner can backdate the exemption, or so they basically, SARS can give a retrospective approval of the exemption, provided that the homeowners association can prove that it met all the requirements during earlier periods and that it had all the supporting documentation. Now, this retrospective exemption is subject to the 3-year prescription limit in Section 99 of the Tax Administration Act. Now, what that also does is it adds a bit of complexity in the sense that the prescription period runs for returns that's been filed and not necessarily for the ones that's not been filed. So it might also be that depending on your circumstances, the effect of prescription may be different. I think what this retrospective exemption also does is it gives non-compliant homeowners associations an opportunity to rectify their position, and if they have been paying tax, to potentially apply for the exemption, and then go and apply that position to previous tax assessments and potentially get a refund if they've been paying tax on their surpluses. Something else relating to the application process that caught my eye. There's a publication or a website newsletter that SARS publishes that's called the TEU Connect, the Tax Exemption Unit Connect. And what one of these newsletters mentions is that there's an online tax exemption system that was launched on the 2nd of March 2026. So I haven't tested it yet, but it seems to be, at least according to this TEU Connect, to be up and running. And from what I've seen in this newsletter, it looks as if these entities must first register for income tax and then they can apply for the exemption. Now, last point that I think if you look at what is in issue 5 that comes through very clearly is that for SARS to grant the exemption, you need a founding document that clearly sets out the purpose of the association, that prohibits distributions, and that also talks to what will happen if the association comes to an end. So I think when applying for the exemption, it's absolutely critical to review your founding document to make sure that it complies with requirements of Section 10(1)(e). Right, so let's recap and see what are the take-home points before I conclude this episode. I think the first one is that if you are looking at any of these entities, your levy income should be fully exempt, provided that you do have the exemption application in place for a homeowners association. Other than that, your non-levy income, the first 50,000 Rand would also be exempt. After that, your non-levy income becomes taxable. Second point, as I've mentioned, the voluntary associations must apply for the exemption. The other two not. For these voluntary associations, there's a retrospective exemption available, subject to some conditions like the prescription periods, etc. I've also mentioned that the interpretation note makes it very clear that your founding documents are absolutely critical to the exemption if you were to apply for that. So if that is something that you're looking at, it's worth reviewing your founding documents very carefully. And then lastly, perhaps more from an operational perspective, is the fact that these applications are now online. So there's a digital platform for this. That's it for today's episode. I just want to remind you that nothing in this episode is intended to be tax advice or a replacement for fact-specific tax advice. Until next time, goodbye.